think we're just about ready to roll. My name's Mark Egan. I'm with Marion Equity. First of all, I'd like to thank Chicago and Kellogg for having us. Just an amazing event. If you could give everyone that put this together. I know we'll do that at the end, but I'd like to do that now. Really an excellent job. So much of what we do, as these folks will talk about, comes out of the business school. So to have you folks really helping us, it's incredible. So here what we're talking about right now is sort of the investor perspective on what makes a good search fund, what makes what investors like to look at, what type of roles they like to take. And interestingly enough, the panel we have here all has different perspectives and different backgrounds and different sort of evolution on how they got into the search fund world and why it's sort of an important part of their life now. So I'd love to start there and let these guys just give the rundown.
Hi, my name's Scott Alderman. I'm a managing director with Trilogy Search Partners. I'm based in Seattle. I have two partners who are based in the Bay Area. Our group was founded by a group of wireless operators who worked together for a very long time, ultimately exited the businesses that we grew and became investors. We've been investing for about the last 10 years with a fund that we capitalized that has been biased more towards early stage tech investments. But in early 2014, we started investing in search funds, and that effort gained a lot of momentum. And this summer, we launched Trilogy Search Partners, which is dedicated to search fund investments.
So my name is Jeff Stevens, and I'll start by thanking Jim Southern and Jamie Turner for attending, because without them, I'd just be the old guy in the room. Like Jim and Jamie, I was blessed to have landed in Irv Grossbeck's class back in 1989 on entrepreneurship, and Jamie isn't kidding when he said earlier that Irv literally finishes the class by saying you don't have to have an idea, you don't have to have any money, and you don't have to have any experience to be an entrepreneur. You just have to know how to mitigate the risk of not having any of those things. I knew exactly why I'd gone to biz school at that point, and that's where I headed. So I was very lucky to have Irv as an early mentor, investor, whatever else you want to call him. I raised what I think was the fourth search fund back in 1990. And didn't realize at the time that I was embarking on a 25-year path in a single community. Was lucky enough to buy a company in 1992, cable television, brilliant departure from Irv's creativity. And in 1996, we sold that business. It was, for the record, the worst outcome of the first decade in the search community with a 35% IRR. So I get that distinction as well. Raised two more search funds and ultimately bought three companies. In 2006, took a quick detour. We'd had our third child and wasn't ready to get on the wheel again of potentially traveling and maybe buying a business outside of where we live. So we founded a business and ran it for 5 years. And in 2010, coming out of that, started the process trying to figure out what was next, and was in conversation with all of my old peers and mentors about what to do next. Everyone was encouraging, let's go look for another company to buy, and then the conversation started to transition to whether or not the best use of the last 20 years of my life was to become a mentor and advisor and investor to this community, and that's where we are today.
Right, my name's Tim Bovard, and we, along with my partner Jeremy and Jake, we founded Search Fund Accelerator as a way to help searchers succeed in buying businesses, along with being their equity partner. My background has been in building up a book printing group across Europe, so about 20 acquisitions to build over a €500 million group, so building that up and managing it. And along the way, I've been, for the last 13 years, I guess, teaching entrepreneurship through acquisition at INSEAD, and I'll soon be teaching at Columbia. So entrepreneurship through acquisition is spreading across other schools. I think Kellogg is going to have a course starting, thanks to the student involvement in that, so that's good. And look forward to exchanging with you.
My name is Martin Steber. I am with Relay Investments, along with my longtime business partner, Sandra Mina. We learned about the search fund model when we were at Stanford, graduated class of =91, and then embarked on our own search fund search and found several businesses, 3 to be specific. Acquired those, and then ultimately evolved our company into a private equity firm. And then in the last few years, we reverted back to getting more involved with the search funds and have now actively invested in the last couple of years in search funds. Currently have sort of 32 search funds that are searching and have made 19 investments in those 2 years.
I'm J.T. Fitzgerald, and I formed a search fund out of Kellogg in 2002. My partner and I acquired a business in Lexington, Kentucky, which we still own today. And through that process, I raised capital through some high net worth family office folks who had not heard of the search fund model before. And so even while I was a search fund entrepreneur running a business, I was helping those folks also continue to allocate capital to other search fund investments, leveraging the network that I'd built. And so over time was able to also invest some of my own capital, and so have over the past 13 years or so invested in several search fund investments, culminating most recently with me forming a small fund dedicated to investing in search funds.
And lastly, I'm Mark Egan with Marion Equity. My father, Bill, started investing in search funds back in 1992 after or during a pretty long career in traditional private equity. And I'm 38. I went to Fairfield University and then Wharton Business School. And back when I was in high school, started looking at the search fund stuff with my father. And as over time, as I developed a little more, have tried to help him more and more as time goes on, and spend most of my time working with search funders and looking at deals. And I love it. And interestingly enough, tying all this together, this is the investor panel, and with the exception myself, you're really looking at a bunch of really, really strong operators, folks that are here now investing because they did a great job operating and had a lot of success. And so I think it's one of the most interesting pieces about this community is that you have a real breadth of folks with different background, different experiences, and that shaped them, and now it shapes them as investors. So interestingly, I think if you find a relatively interesting company out there and you have an interesting pitch, you'll probably find an investor or two or three that will really connect with you. So, and with that, where I'd like to go is just sort of down the line. I think you'll hear some of this is just a random question. Maybe we'll start the other way and work backwards. Is what makes for a good search fund?
The search fund entrepreneur, what makes for a good entrepreneur, or
a good search. Let's start with the search fund investment, and then let's go to the deal. So as you start with the search, what's important to you, and then when you move into the deal and that next layer, what's important to you?
Okay. Yeah. I mean, I think that search funds in general work really well. The sort of the trinity of a confluence of three factors that come together. The first is typically looking at opportunities in the lower middle market. And I come from sort of a value investing penchant. So I think that the lower middle market represents maybe the last bastion of opportunity to buy businesses, good businesses, for decent multiples. The second leg of the stool, so to speak, would be the management enthusiasm and talent. So you're matching bright young people with all of you who are brighter and more competent and harder working than me, and putting them into work in small companies that heretofore probably couldn't have attracted them. And I think that's a unique combination. And then the final leg of the stool is this sort of perfect alignment of incentives where you give those bright young people a very meaningful stake in the equity upside of the business. And so I think the confluence of those three factors forms the foundation for what makes search funds work in general.
I think one of the key components is a well-prepared searcher, somebody who's really done their homework and really realizes what's involved, how hard it is, how many no's you're going to have to hear, and all the detours that get you from initially raising the search fund to hopefully finding a deal. So we focus a lot in our diligence of whether or not we would invest in the deal on that sort of period of the search where we look for what kind of updates we're getting, whether the deal sheets, the summaries are meaningful, whether it's helpful to make a decision whether or not to invest. If we don't hear from somebody in sort of 6 weeks and check in and they're struggling, then we try to reach under their shoulders and help them. But the key criteria for us in terms of investing in a deal is ultimately based on whether the searcher during the phase can demonstrate that they have what it takes to run a business.
I would say that we really do adhere to the search fund criteria that have been developed over the years, the collective wisdom, and I think adherence to that is important. And to adhere to it, I think you need to have a significant pipeline. If you have a pipeline, that gives you the confidence as a searcher to kill deals. And we heard that earlier today, Jim Southern saying the ability to say no. You can say no if you've got a whole host of deals that you're working on and the confidence that more will be coming in. So that's the first thing, so that you can adhere to the criteria that really match the company to the relative inexperience of most of the searchers who are going out and being first-time CEOs. That building that pipeline is really a sales job, and I think what's interesting is the sales job during the search is equivalent to the sales job after the search when you're running a company, and I think the first role of a CEO is to be the #1 salesman of the company. So that goes hand in hand, and it's just this, we don't, since in Search Fund Accelerator we're in constant contact with a searcher, it's really interesting because from day one we know what's going on, we help them formulate LOIs, we go along in step with the searcher through the process, so it's really a partnership, and that's rewarding, I think, for the searchers and definitely reassuring for us because we know the deal as intimately as the searcher.
So before I answer, I just want to confirm Mark's earlier comment about starting very early in this process. Every time I went to meet with his father in Boston, which was frequently, Mark was in the office listening to the conversation. So he was at 18 finding out everything going on and probably hearing a lot of stuff he didn't want to know about how not to run a business well. We get asked all the time, what do you look for in a searcher? And I'll tell you, it's obviously at some level a speed dating process, which is probably frustrating for both parties at the front end in terms of trying to figure out, who is this person? How are they wired? What are they consistent with what we're trying to do? And it should be, by the way, a two-way street. This should absolutely be a two-way interview. You should be figuring out whether or not the investors you're talking to are the people that you match with and that are going to be the best partners for you over the extended period of time. With that said, we generally talk about 3 things, and they're difficult to assess in a short period of time, but this is what we look for. The first one is your alignment with the model. There are multiple paths to entrepreneurship, and this is but one, and that's great. There are also multiple paths to entrepreneurship through acquisition. Tim's got one option. The Harvard folks teach a self-funded option. This is another option. So there are lots of different ways to do this, and you should figure out which one is best for you, and you should take the time to do that. What we want to do as an investor is partner with people that we believe have the highest probability of ultimately finding opportunities that we get to be involved with for an extended period of time. That's the goal, is to really develop a deep relationship. So what we say is there's a significant difference between memorizing the search approach and internalizing the search approach. And we are looking for people who have internalized it. Do you accept, appreciate, like the types of businesses that we talk about? Can you imagine buying a business that doesn't look like that? We're all going to look at them, and most of us have probably been involved in businesses as operators that didn't look like that, and that's okay. But at the end of the day, the stronger that alignment for us anyway, the higher the probability that we're going to have a terrific partnership over a long period of time. Number 2, can you lead? We used to say, can you sell? But now I think it's a little broader than that. At every stage in this process, you're going to be trying to get people to follow you. And that's just fundamental. You're going to ask investors to back you in the search, then you're going to try to get business owners to believe that you're the right person to hand their company to, their baby to. We heard that earlier today. It's absolutely true. Then you're going to go back to investors and banks and others and try to convince them that this is the right opportunity to partner with you on. Once you get the deal done, you're going to have customers, employees, vendors, et cetera, that you are going to try to rally around your vision for this business. So can you lead? And that's not an easy thing to assess early on, but that is certainly, to JT and Martin's point earlier, that's something we assess throughout the process, throughout the search. And one of the beauties of this model is the opportunity to sort of learn together. And then the third one is, can you listen? You've heard countless times today what a community this is, and that is beyond true. There is so much talent and so many resources in the search community available to you if you're willing to take advantage of it. And so we love to probe and ask questions and sort of see what people do with feedback. By the way, listening doesn't mean agreeing with what we think. It's totally fine to have a different perspective, but are you willing to take feedback and do something with it?
Yeah, I would just add to that. Really probing why a searcher thinks they want to start a search fund, and making sure we feel like we're in it for the same reasons. I think you could view the search fund process as a really leveraged way to learn how to fundraise, how to create an efficient sourcing engine, how to work with sellers and negotiate and structure deals, and then ultimately how to gain operating experience. And those first three things are all the means to the end of running a business. And so we're really wanting to partner with folks that are truly passionate about running and growing a business. And we look for evidence in their background, in their story that's consistent with that desire.
Yeah, I think for us, and it's more of a softer issue, but I think for us it's really about the searcher or the team putting sort of their stamp, their own personal stamp on the activity, and really them having conviction all the way through. Whether that's at the first search phase about the investors they bring in, or when they get to the deal about who the investors they really want to lead the deal, what folks they want to go on the board. Sort of to Jeff's point, being able to mine those resources that are around them is really important to us. And then also them having that conviction that this is the opportunity they really want to attack. They want to move their family there. They want to live there. They want to become part of the community. All that stuff is they're softer issues. It's stuff you don't always touch upon in a memo or at business school, but it's really important stuff. Because one of the big things that we see throughout is the deals that we're able to hold for a long time. And you don't hold stuff if it's not, if it's not growing. But the companies where you have an entrepreneur or entrepreneurs that are able to go after it for a long period of time and really stick with it and have conviction, we've done extremely well. And we also think and it's relevant to this room, in terms of entrepreneurship or buying companies these days, the biggest player there is private equity, right? And the one differentiator that search funds have versus private equity is that if you go buy a company, folks are going to live there. They're not, a partner at a firm getting on a plane and going back to San Francisco or Chicago. And the reality is I'm a private equity investor, right? So I'm a little bit competing against myself in some regards. But it's a huge differentiator. The fact that folks in this model are willing to source the deal and then go live there and make it a part of their whole life, that to us, so folks, so to make it actually something you can learn from, I think that's the key. But I think what we evaluate is how badly do they really want it? How important is this, how much have they thought it through? Have they had those discussions with their family, or is this something that's sort of, they're just hoping it happens and waiting for the result down the road? So let me just check we've had a long day here. I think all of us agree it'd be great to you sort of know our backgrounds. It's a bunch of different investors with different experience, operational, non-operational in my case. So I'd love to open it up to you folks for the last half hour, because you've been really great to have us, and really, hit us with whatever question you want. I think you got a good mix of folks to be helpful, and then we'll all move on to drinks.
So no questions, right?
Hi guys, thanks. How open are you to look or fund businesses in South America?
I'll start here. So I think all of us, for the most part, have looked at international search funds. I was actually in Andre's fund here, and we didn't end up doing the deal. And again, that kind of goes back to some of the stuff I was saying earlier, is that I felt those guys had conviction there, but my father and I didn't have sort of conviction about Mexico and didn't really think that that was a deal that we could add value. And they had also put together a tremendous group. So, you know, for us, I think there, to answer your question, I think there is probably an appetite to do search funds anywhere, but then you're really going to have to drill down into the specifics. You know, if your relationships in Argentina, you know, when Andre didn't just come through and say, hey, I want to buy a company in Mexico. I mean, he had Mexican investors, he had US investors, and they really had a real story and a real thesis behind it. So I think that's what you kind of need to see, whatever country or whatever city you go to for that matter. But I'll let these guys follow up.
We've been quite active internationally. I mean, we have a Kenyan search fund. We have in India, we have an active deal that was sourced through an Indian search fund. In Spain, surprisingly very little in, no search funds in France so far. Have you come across any, Tim?
There's one coming right now.
One coming, yeah, here we go. So we're very open in terms of geography, but sort of the typical deal characteristics would stay the same. I mean, we'd still be looking for, you know, stability, recurring revenue, repeat business, et cetera, et cetera.
So I think, you know, take it up a level. There's a subset of the investor community in the search world that is open to international search. It's not everybody. I think when you think about international search, you know, really at the end of the day, the balancing act that investors are playing is, what are the risks that I don't understand? So I don't know the legal system, you know, in a number of these countries. I don't understand how business is transacted. You know, I don't know how big the number, how many targets there are in Mexico. What's ended up happening in a number of cases is that interesting business models have been started rather than acquired, which has worked well, but it's a different model. So investors are weighing those risks against both the opportunity for the entrepreneur, and then I think in large part, most investors will tell you, they want to know if there are untapped markets to facilitate business models that they already have success with here. So, you know, South America would be a good example of a place where you might be able to take business models that have done very well in the search community here and translate them because they're not as well developed. That would be intriguing to some, not all.
Do you think good search fund investors, or it's possible to be a good search fund investor without being a former searcher? And if so, what are some things that maybe future search fund investors who don't do searches should think about in terms of kind of developing and getting into that space?
It feels dangerous. Listen, you've got a bunch of operators sitting up here, and you heard earlier the importance of having operating capability on your board. I would say also within your investor group. There are very successful investors in this community that come out of an investing world that have never been quote-unquote operators. Now, operating a private equity fund might be operating as well. So it can work both ways, but I think that like anything in life, we all need to understand what do we bring to the table where we can add a lot of value or strengths, and what are the areas where we just don't bring something to the table, how you're going to cover that. So if you're going to come into this community as an investor without operating experience, probably making sure that you develop relationships with investors that do have that background, you figure out how to work with them would be helpful. That would be my bias. That's what I see with a lot. You know, Mark probably has a good perspective on this.
I mean, I think the... So in terms of if you're a searcher building it and you're looking for, I think the key there is you want a mix of folks, and you want to realize that, you know, the entire search fund community is not going to be on your board or be your investor. So you really need to, you know, I'll bring up baseball while I'm in Chicago, but you really want to think through your roster and think through who you know plays the different spots for you. But in terms of getting into this as an investor, I think everyone would agree here, it's not sort of something you can do as a one-off activity and you know, do a search here and a search there. I think, you know, you have to be committed and do a bunch of them and spend time, and this is a much longer conversation, but I think for a lot of us who have gotten in the search fund investing, you realize that there's a little lead time before you start doing deals, and then there's a much longer lead time before you see any exits.
I think the operational side is really important because during the due diligence phase, I think that's where you can make a lot of mistakes if you don't understand how the company is really run. Because yes, you create value, of course, at the time you buy a company, but most of the value is going to be created running it not for 3 years or 5 years, but for 10 years, as we've heard. And being able to surround yourself with people who can help you once you're in the CEO seat, I think is really key.
I'm curious to hear your guys' thoughts on partnerships versus solo searchers. I know in the past there's been research that shows that partnerships perform a little bit better, but now the trend is skewing much more towards more single searchers. And then also, in addition to that, when you're thinking about partnerships, what do you think is the ideal makeup of the two, of the pair, personality-wise, experience-wise, et cetera?
Yeah, I think that's a great question. I'll take it because I was a searcher with a partner. And in large part to help mitigate some of my weaknesses or blind spots that I had, I sought out of a classmate who was also interested in the model because I think that there were facets about his background and the work that he had done before business school that would help round out us as a team. And that comes with trade-offs, right? Not the least of which is the economics. So, purely selfishly motivated searchers, it's always better to do a single search. And so you're giving something up, and you have to think about what you're getting in exchange. In addition to differences of background, he had a little bit more deal experience than I did. He was going to help on the front end a lot more. He also was agnostic to region. I had a little bit more regional constraints, so it sort of expanded the types of opportunities we could look at. And so now as an investor, I look at both teams and single searchers, and so I think about when I look at a partnership. First, interpersonally, how are they going to get along? How do they behave together in an interview? And coming back to Jeff's comment earlier, it's a little bit of speed dating. So you're trying to flesh that out over lunch or in an in-person conversation. And so you're trying to get a feel for how these two personalities are going to fit long-term, because it's a long-term marriage. Sometimes they've just met each other in the last few months. And then do their backgrounds lend themselves to being sort of 1 + 1 = 3 is the simple way of saying it. And if there's a weakness on one hand, can that be offset by a strength on the other, both on the risk capital up front on the search, but probably more importantly, once they become operators?
In our model, we only accept single searchers. I think a lot of partnerships, and I understand their statistics, but the data set is so small that I don't know what we can really make out of that. But the search is a very lonely process, and I can perfectly understand why somebody wants to partner during that process. But you're going to be buying a company in 18 months or whatever, and you have no idea what kind of a company that's going to be. And so if I were thinking myself searching, I'd say, well, listen, if I'm a single searcher, I get 25%. If I'm a team, we split 30%. So I'm giving up 40% of my equity for the search, and I don't know what skill set I'm going to need to complement mine really to run a company. So I would rather find the company, buy it, and then see what middle management there is. Are there skills lacking? And if there are, I would rather hire in somebody as either a pure employee, because a lot of people in those size of companies don't know what equity is, don't care about equity. They would rather receive a bonus. Or if you do need to give equity, it's 2%, 3%, 4%, something like that. And so you're way ahead because you've retained your equity and you've got the right person in the role for that particular company.
I would offer that it's not that calculating. Not Tim's comments, but just the whole thought process. I think most of us are wired one way or the other. I think most people coming into this process either can't envision doing it without a partner, or think that would be a significant deterrent to their motivation to do it, or can't imagine relinquishing control or the equity, whatever it is. So, I mean, our sense is the vast majority of the people we meet. By the way, I started with a partner in 1990 and lost him 9 months into the search, just in terms of things going on in his life that he couldn't commit to it anymore, and it was a very difficult decision to continue searching alone. I actually didn't plan on doing this by myself. But I do think that most people probably have are probably predetermined that they have a bias one way or the other, and I would follow that. The only comment I would make is if you either are trying to match the statistics that say partnerships do better, or trying to match the tactical aspects of just double the bandwidth, particularly during the search, one person can be still sourcing while your diligence can deal, what have you, don't manufacture a partnership to meet those needs. It is an incredibly long-term commitment. You heard it earlier from other people, and you've got to make that decision as seriously, if not more seriously, than almost anyone you'll make in this whole process.
And just to echo what Jeff was saying, there's been lots of dual searcher teams in the recent past breaking up because they didn't go to the level of depth of understanding their respective contributions to the search. I was very fortunate in the sense that I met Sandra in the early 80s, and then we ended up at Stanford together, and there was no question that I was ever going to do a search fund on my own. But together, we'd known each other for a decade. We were at business school together. I learned about the model there, and it was a natural dual search. But I think it's incredibly important, and I think we've made a few mistakes in the recent past around teams of two, where the team chemistry was not correctly assessed on our end, and it ended up, falling apart. So, if you're going to go down that route, you just make sure that you're doing it with the right partner.
Is this on? Yes. When a searcher approaches you, will they be more favorably viewed if they come to you industry specific or industry agnostic? Is there any advantage either side, or disadvantage?
I would say, first of all, I think it's really helpful when they come with an idea or ideas, if for no other reason than to see their thought process, to see how they think about an industry and characteristics of a company. And I think that's a great, conversation starter to see how people think. I don't think typically there are some searchers who have a very specific strategy of going after an industry they're particularly experienced or passionate about, but I don't think there's typically an expectation when when a searcher describes 2 or 3 industries that they think are interesting, that they will ultimately end up acquiring a company in those industries. Very often, that may be where they start, but they end up someplace else.
I think that's actually an important question. I think to touch it, as Scott said, it's very important to us that folks have an idea or ideas, and they have some conviction around those ideas. And it's something, when I look at the evolution of the search fund world, we all talk about 2-year searches, but the one thing you saw in the 90s and definitely earlier before, and it's shifting a little bit, is that they were more like 2.5 to 3-year searches. I'm sure Jeff didn't just get Irv Grousbeck signed up and start rolling. So I think it really is part of the exercise when you decide, do I want to do this? Does the search fund make sense to me? I think you really got to go to that next level and say, okay, well, if it does, well, then where am I going to hunt for stuff? What's an interesting, because really what you're thinking about is spending the next 10 years of your life at an activity, and again, being part of that industry or being part of that community. And so if we don't really get some initial ideas, and again, to Scott's point, you don't need you can move off it, you can find something else interesting. But if we don't sort of see that passion and the thoughtfulness about some specific ideas, it really is tough to gauge whether, and it's less about us gauging whether they really want to do it. It's about us, whether we can connect with their energy.
The only thing I would add is the search process. Timothy talked earlier about making sure you have a full pipeline. The search process is about maximizing the probability of a successful outcome, which is getting a deal done. And any limitation that you put on that creates incremental challenge. There's a reason that by and large this community doesn't back geographically constrained searches. You know, the idea that you find an interesting industry and there are 20 of them in the geography you want to look in, but 300 in the country, and you're only going to look at the 20, feels like you're really limiting your opportunity for success. I think that's probably a little bit of where the investors go with industries as well. I completely agree with Scott and Mark about the passion and having ideas about where you want to start, but being willing to transition and making sure that you maximize the probability that you're going to get something done versus being bullheaded about, I have to find something in this space.
All of you guys obviously bring a breadth of experience to the investing side and throughout search funds. One thing that I'd be interested to hear is kind of how you've seen the landscape change over different macroeconomic cycles, and how maybe, I think it probably goes without saying how the macroeconomic cycles affect the operational aspect of the business, but particular to raising a search, how maybe the ebbs and flow of capital, and maybe some things that we should consider when we think about raising a search, how we should consider the macroeconomic variables there.
I'm going to start, and I'll just focus on the deal side. I mean, definitely, you know, searches succeed and fail through all phases, but they're easier in more difficult periods of time. This model is predicated at the fundamental level on maximizing the margin for error. That's what everything's built on. That's why the criteria exists. This is about taking really talented but inexperienced operators and putting them in settings where they have tons of time to figure out what's going on and then take advantage of it. One of the ways that you can impact that negatively is if you get too aggressive and you don't allow yourself to manage through cycles. I think everybody raising a search fund right now should assume they're going to live through a correction of some sort. We don't know when, we don't know how big. So the search community, as a rule of thumb, is very conservative in their capital structures. We don't put a lot of debt on deals even when it's available. A lot of that is just to make sure we still own the business through that cycle, and that's probably the biggest thing for you to just think about and make sure that you're comfortable with. It's not about getting another turn or turn and a half of debt because that can improve IRRs on a piece of paper. It's about making sure that you have control of the business.
I'll layer on to that. I remember specifically, you know, '08 was a very interesting time because, you know, for the prior years before that, if you found an interesting company and you had these, you know, a great investor group, a lot of times the banks would chase you to get in on that deal. And then suddenly you had entrepreneurs in '08 that, you know, they were talking to 100 different bankers to get one bank loan, and so what I would say is, because of, you know, to Jeff's point, that we don't really lever the deals up in a huge way, and then we probably are doing smaller deals. I don't think, you know, it's a situation where the cyclicality where we get killed in a bad cycle or we make a ton of money in the ups, but the reality is, I think it probably, the investors, and then more specifically the entrepreneurs, have to even, you know, you just have to work harder. You have to work smarter, and you probably have to, in a downturn, you probably have to do some things that are outside of your comfort zone. And so to Jeff's point, I think preparing for that is important.
Just one additional point here, and I think this gets misplaced in the community at times. The most thoughtful and conservative voice in this conversation should be the entrepreneur. Every one of your investors will be able to absorb a hit if your deal doesn't work. Whether it's for macroeconomic reasons or it was a bad industry, what have you, you're making one bet, and you're making one incredibly significant bet. So, you know, I think, you know, we're probably considered at the conservative end of the spectrum on the investor base in this community, but we tell entrepreneurs all the time, you know, you should be the most thoughtful voice at the table because you're putting the most at risk here, and your investors are going to be right there with you, but they're going to have ways to diversify.
Just later on, that one important thing that I think is, you know, my father and I really push all the entrepreneurs to act as if you've hit your hurdle. Act as if you're a 25% stakeholder in the search and in the business. And I think with, you know, if you can remember that, it'll help you work through a lot of the tough times.
I mean, it's a very prudent question given where we are in the cycle today, and I think you have to understand that in the size of the companies we're talking about, the addressable market for you is essentially infinite. We're not talking about mega companies here where your market penetration is at saturation. So you have infinite market to address. You just have to have the hustle and the smarts to go out and get it. And the second thing is, in the search fund model, there's no need for the investors to sell in 5 years to have liquidity, as we already heard. So you can hang on to it right out the cycle if you're not overly leveraged, if you manage your cash well, and wait for better days.
I'll just add on one last comment. I think what's coming through here loud and clear is that for all of these folks who invest in search funds, that they view equity as very precious. And so they're going to be conservative throughout the business cycle with the way that they put it to work because there's enough risk in the model already. So if you're coming out as a prospective searcher and the market is a little bit frothy and you're going to have to stretch to get deals done, it might be a little bit harder to get those financed with the search fund community. But that once they are invested in it, they're going to be very patient and make sure that you're not subject to the vagaries of the business cycle once you're in the business.
I had a follow-up question to that, to the macroeconomic levels and kind of the capital flows into search funds. And I was just wondering if you guys have seen more and more investors trying to invest into searchers, and also if you've seen more searchers trying to get into the business recently over the past few years.
I mean, yeah, both, because of amazing events like this, though. So I don't have a real long answer, but yeah, it's grown rapidly. You guys, some of the numbers.
Yeah, the number of searches is growing, that's for sure. The number of investors as well. I think there's a lot of new investors coming into the market, and that's been the case for us. And I know the other investors at the table are welcoming other investors into the market because there's a need for the human aspect of the search fund model to enlarge the community to follow with the increasing number of searchers.
Here are the practical realities are simple. In 2005, there was 5 active searches at the beginning there. 2010, there were 15. Right now, there are 95 active searches and 26 funds trying to raise. So we'll be over 100 before the end of the year. We're not on a linear curve. We're on an exponential growth curve, and that is going to require that this community figure out how to adapt. Now, I think the hope for most of us up here is that adaptation is finding more people that are like-minded about what a good business looks like and adherence to the model rather than expanding the scope of what we're willing to do. But we're going to need to figure out, someone said earlier, there are 3 legs to this stool. There's really talented entrepreneurs, there's great companies, and there's terrific oversight. And Irv said that in 1980-something, and it still rings true today. The investors have a significant responsibility here, and we've got to figure out how to do our job.
Thanks for participating in the panel. I just have a question. It's from the perspective of being a search fund investor, how do you think about portfolio construction? It seems that during this phase you have a bunch of options, but when you're actually making the investment, how do you think about the size of the investment, the industry exposure that you have, duration? Just some thoughts on that would be great.
I mean, a current theme that Sandra and I are struggling with is the emergence of software as a service. It seems the most popular current trend pursued by searchers, and as a result, I think we already have 5 or 6 of those, and are concerned that we'll have to say no to, some in the future for sure. So that's one of the challenges. With that challenge, particularly in the software arena, is that there's not that many experienced board members that have deep industry, knowledge, software, hardware, and that's a challenge that we're also trying to solve by reaching out to, friends and friends of friends who have some technology experience, being on boards, helping conversions of software on-premise to cloud, et cetera, et cetera. So it's a very hot topic right now.
I agree with Martin that there's a surprising number of software deals that we're being presented with. And, SaaS companies can check a lot of the, the boxes of the traditional search fund criteria. But, I would observe that a lot of searchers unless they're from the software industry, have a hard time evaluating technology risk. And that's an area where they really want to make sure they have the right advisors and they lean on them when they're evaluating companies, because they're definitely great, stable software companies where the secret sauce really isn't in the technology, but that's not always the case.
I would tell you at a macro level, most investors, and this is broader than the search community, will fall into one of two buckets. They're trying to get the great outsized returns or minimize risk. So in this community, we kind of talk about, who are the investors that are trying to make sure they're in the next top 3 deals, and who are the investors that are trying to make sure that they're not in any of the 30% that didn't return capital. I think most of the investors fall into the second bucket here, so it's less about diversification of industries or lack of concentration or what have you. It's this thought that, the first priority in the investment process for most investors in this community is, can I mitigate risk? There is an unpublished, I wouldn't even call it study, it was a simple sample, data sample collected by someone that some of us are pretty close to here, who got all of the investing data from 4 investors in this community who have been very meaningful in terms of velocity, the number of deals they've done over an extended period of time. And they're all very, very traditional long-term investors. And they compared those 4 investors to the Stanford numbers that you see every 2 years. And what was interesting about them is, first of all, they were no better than the group as a whole at figuring out who was and was not going to successfully actually acquire a business. They had the same 75% success rate that the broader community had, but taking out the top 3 outcomes, they produced almost 6 times the money on their investment, while the Stanford study says it's 3 times. And the most compelling number of this little analysis that was done is the deals that those 4 investors collectively passed on produced 0.8 times the money. So what they're really good, what the core investors that do this a lot are really good at is avoiding the bad deals. And that's where this whole listening concept comes in, taking feedback. You're going to get a lot of different feedback, and there's going to be somebody, like Mark said, that'll back almost anything. And figuring out what to do with the information is huge.
Hi, I was just wondering, what trends have you seen with women being searchers, and what advice do you have for women?
Yeah, well, I mean, I don't think we don't see a lot of women doing it. And I have 4 daughters myself. I don't see any reason why more women shouldn't do it. But yeah, I don't know.
I think I've gotten a chance to meet most of the women searchers, and I think it's fantastic. We have one of the 4 searchers at SFA is a woman, and there is absolutely no reason for women not to be involved in this. None.
And we've had women be very successful as well. So it's more just you can look around the room. It's more literally, I would say, how many women come to the events and sort of follow it through. It's just it's been a lot more men. But all this stuff, the interesting thing I say with all this is that when this first started, Jeff went to Stanford, so he fell in the bucket. But if you kind of didn't go to Stanford or Harvard, you weren't really going to get funded. Then it was, it expanded the pool of folks, at the business schools. But if you were sort of too far out of business school, you probably wouldn't get funded either. And then there was, some older folks that came and did really well. So it really is all about the specific person, whether they're, male, female, yellow, red. It really is about the specific person. And then back to the question earlier about their ideas and their passion and conviction.
Yeah, I will echo all of those comments. We probably don't see enough. Would love to see more women doing searches and running search funded companies. This gives me a nice opportunity to come back to the very first question, which I realized after I was sort of answering it that I didn't do a very good job of answering the question. So I can say that for me, what makes a good operator in a search fund, in addition to drive and alignment with the model, is a high degree of what a lot of people call emotional intelligence, but I would say is empathy, self-awareness, and humility. And as a fresh-faced young MBA, I didn't have any of those qualities. And so when I started managing a company, I relied on my wife a lot for some of those attributes. And so I think that there's maybe in many cases a missing skill set that would be filled by more women searchers. So I welcome you to the group if you're interested in doing it.
But you know, there have been some very successful women that have done search funds. So if you'd like to be put in touch with some of those, let me know.
We got Kelly right here, and she's fantastic and full of energy, and I'm sure will be outstandingly successful.
Remember this face? I'm going to do this. I'm waiting to say that all night. How long do you like investors, or how long do you want searchers to hold companies before they turn over?
Once they're operating a business, how long?
Right.
Never. But I'm different. I mean, if it's growing and it's doing well, we would just assume. I mean, one woman, Karen Moriarty, has been around. When did Karen start?
She was
91.
She was class of 91. Yeah.
Yeah. So I mean, there's deals we've been in for 20 years. So.
Yeah, I mean, listen, you know, Jamie was up here earlier. They bought their company in 1987. They still own it. Karen went out in 91 and I think built the first facility in 93, 94. They still own the business today. Assurian, which is the story everyone knows about, bought, you know, Road Rescue, Mr. Rescue in 1995, and they still own the business today. You know, I mean, people will look at us and say, well, you're a fund, you have a life, you have LPs. That has no impact on what the right answer is for the business. If a business is doing well, you can recapitalize, you can figure out how to take care, and it won't be just institutional investors. There'll be investors that are ready for liquidity at different points along the way. Good businesses can be held for an extremely long period of time and should be.
I think you as the CEO, you're also in the driver's seat. It's really your business. You're not the majority shareholder probably, but your investors can change, and you can stay on and continue managing it. And that will be your choice.
Tim makes a great point, and it's pretty true of most of the businesses we're in. But my father always uses this line. He got it from his father. He said, "When the conductor, you know, is getting off, you should get off as well."
Yeah, I mean, so Mark and we were in a deal that just sold in September incredibly successfully, and a big part of the reason that it went out after 4 years was the entrepreneur wasn't sure. He didn't say, I won't run it anymore. He just wasn't sure. And so he said, let's go through a process and see what our options are.
Yeah, and so for the most part, that is coming from the entrepreneur first.
I'll just add that good companies are really hard to find. So it really comes down to the opportunity that capital deployed in a good company. And so we'd probably much rather have it to go, staying at work in a good company and compounding over time than sort of manufacturing an artificial exit just to put sort of IRR numbers on the table.
But you can obviously, within the search fund community, have people that investors that want to get out, and then either new investors come in or existing investors buy in additional. So there's lots of flexibility, more flexibility than people realize with the search fund model on that front.
We have time for one more, and then
My name is Raghu Malva. You mentioned before about the software as a service industry being the most attractive or one of the attractive industries for search funds. Could you elaborate on that and what kind of checkboxes that industry particularly tick, and what kind of businesses typically come across your deal flow?
I'm going to give you our pitch, and it will evolve over time, but there's a laundry list that everyone probably here has memorized of what the criteria are for a search business: recurring revenue, low capital intensity, geographic fragmentation, et cetera, et cetera. Every investor has probably 2 or 3 of those criteria that sit above all the others in a bright line. And for us, it's predictable revenue and simple businesses. And I would tell you from our view, and it's not a well-educated view because we aren't tech people, software businesses are far more complex to run. You're living in a much quicker development cycle. You're living with exogenous variables in terms of competitive landscape, what have you, that can put pressure on a business in the first 12 to 24 months that's inconsistent with the idea of going in and taking your time and learning and just making sure it's stable. So that's where we're challenged with it, but we're going to watch and see what happens. I do think also there's some risk that deals will get done because investors, this is a very aligned model, and with a few exceptions. I think this is one of the places where the exception could be the case. Investors that invest in software deals and build portfolios in this community can have 3 out of 10 work well and probably do very well. And if 7 out of 10 entrepreneurs don't succeed, that's not good alignment for all of us. Wow, killed the room.
I would just add, and we have invested in some software companies, but I think Jeff mentioned recurring revenue. There's also this allure of, well, if I can find a software company that has a licensed software model and I can migrate it to a SaaS model, there's a nice multiple inflation that I can capture there. And I would just point out that migrating to a SaaS model is, no trivial matter, and that is not something we would, be excited about watching searchers, base an investment decision on that need to relatively quickly transition to that model.
So for us, I think we're not technology folks at all. We understand it enough to be dangerous. But I would say the SaaS businesses we invest in, it's more that we're investing in probably the industry or the area they're attacking, and the technology is sort of a component of it. And we probably understand the market dynamics more than the technology per se, and try to have some other folks around as investors and on the board that know the technology side of it more. But the SaaS thing is interesting because with the recurring revenue and the service component, it kind of fits into the search fund model. Fund a lot of capital to fund a conversion to SaaS, and that sort of cash drain is not typical with the search fund model. As Jeff says, a lot of that stuff will evolve. And I also think that, even within those SaaS businesses, people have a very different approach. Some look at it and how do I mine it for cash flow right away and maybe grow a little less, and then other folks are thinking, how do I blow this out and create a big business? But what I say to folks there, a lot of those decisions are then made, once you get to the company level, and you probably have a smaller investor base and a smaller, in a board. So it's less of sort of, does it work for the search fund community, and more about, does it work for that specific group and that deal. But definitely, I think the SaaS probably adds a little layer of complexity, or anything that is capital intensive in the search fund world, I think adds a layer of complexity.
Jeff mentioned exogenous factors, and I think that's something that you don't have. When you're dealing with very basic services or industries, you don't have a lot of intelligence coming in to knock you off. Whereas in the SaaS IT space, you've got a lot of people armed with a lot of money and a lot of experience who are coming in to find ways to knock off that company and be the next new name in that space. It's a different playing field.
And they're motivated potentially by very different things. It's about revenue, not cash flow, what have you. So it can be a very different landscape.
Wrap it up. Great. Well, thanks again for having us. I really enjoyed it, as we all did. And again, thanks to Chicago and Kellogg. Just an amazing event. I guess we'll have to add a room next year.
Good job.
Just wanted to make some closing remarks. My name's Corey Pittman. I'm one of the co-chairs of the Search Fund Group at Chicago Booth. Wanted to thank you all for coming out for such a great afternoon. Thank you to all the sponsors who we couldn't have done without. I'd like to give them a round of applause. To all the panelists who, none of us would be here unless we had such great panels all day long. Really appreciate you all coming out. And to the co-chairs at both Kellogg and Booth, to the Polsky Center, and to also all the admin at Kellogg who were able to make it possible. We have a happy hour right down the hall in College Hall from 4 to 5:30 this afternoon, starting right now. And so please join us, and thank you all again for coming out.